Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me on his own podcast, the Governor of Beckerville, USA, Mr. Michael Becker. How are you, sir?
Hey, Paul. Doing well. How are you?
I'm doing all right on this last day or so of June going into July. It's still very warm outside, but they're starting to shut the state down again. Michael, what's your take about the opening and closing and opening and closing? I mean,
seems like today the governor's pulling back a little bit on restaurants are going to go from 75% occupancy to 50, I think, and then bars are going back to 0. So I don't know. It's not good. It's kind of up and down, a little bit of a yo-yo. We're starting to see some decent progress, kind of getting back to recovery. So it seems like that's going to kind of put a little bit of a pause on it, at least temporarily. But lenders are back, at least for now, and pretty cheap 3% IO money is kind of like what we talked about. So it's kind of really supporting pricing, and collections are still pretty good, and overall it's holding up okay. I guess we'll see how when July the additional stimulus runs out, and as we get closer to election. Seems like a lot of variability in the marketplace. I don't know if it's gonna go super high or fall through the floor. It's kind of seems like the risk spectrum's pretty wide right now.
I mean, that's an important point is when you talk about 3%, interest rates that are out there, unbelievable. I mean, our guest is going to talk a little bit about the history of what he has done for a long period of time in this business. But I remember when I first got in the business, prime rate was at 21%, home loans were at 16%, and now we're talking about, a 30-year amortization, 3% for 10 years. I mean, just unbelievable numbers. But just like 1 + 1 = 2, if you have a 3% interest rate and you have a 5 or 5.5% cap rate, do those numbers work, Mike?
They work well, especially at 70 plus leverage. You should be able to print money in that scenario.
Yeah, it's it really is very interesting about these times, because we've kind of seen that, what we have said before, that if you fell asleep at the end of March and you woke up today and you looked at your P&L and how that's done and how collections have done, you really probably wouldn't notice very much of a difference of people actually paying their rents the last, say, 3 or 4 months going through this craziness. And, I think a lot of sellers are still very positive on their properties, and they're very proud of their properties. They're still trying to get the same price, but the government has helped us also by keeping the interest rates low. So when you do have that mathematical equation of 3% debt and 5.5% cap rates on some of these properties, that you can make money, and that's, I think, an advantage of where the market is right now. So Michael Becker, as you know, is gone from loaning money to owning real estate, and he's done a great job of doing that. And so we certainly do appreciate Michael being on in part of the podcast. Second thing is that if you do think about buying your own property down the road, and you want to get some information about what needs to be in to get the loan, go on to the Old Capital Podcast, oldcapitalpodcast.com, and download the 17-page white paper report. That I think is a very good one that kind of gives you the outline of what you should expect when it comes to financing. And, it has it all laid out. So if you've never done it before and you kind of a chart, I mean, that's kind of a one that gives you some inside information on what we as the lender are looking for. Second part is, Michael, what is the due diligence piece that you wrote, or what SPI uses?
Yeah, on the website, we have our sample due diligence checklist. It's kind of like I describe it, like the Christmas wish list. So when we're buying deals, everything that we would want to see from the seller on a potential acquisition. So we put that actual checklist that we use on the Old Capital Podcast website, and you can feel free to download it and change the name, but use it for your own if you're submitting LOIs. It's a pretty comprehensive list.
That's great. So, we do definitely appreciate Michael building that for us and putting it on the oldcapitalpodcast.com website. And again, if you think we bring value to you and some of the discussions that we have with some of the leaders in multifamily, please give us a 5-star rating. We do appreciate that. Again, we're just trying to tell you like it is, and we're not looking for anything. We just kind of give you the basic information about how multifamily works and how it's made millionaires out of a lot of people, and why it's still a pretty good idea when you are thinking about investing to think about multifamily instead of retail or office or anything else that comes with multifamily as a competitor buying a hard asset. So, Michael, do you know what 1983 stands for or what symbolizes maybe in this conversation? 1983.
You tell me, Paul.
1983 is when our guest on the podcast started in the multifamily business. Yeah, 1983. That's a couple of years ago. And so on the podcast today, returning visit with Michael Ochstein. Michael Ochstein with Price Realty here in Texas. Michael started his journey on the broker side in 1983. He's a strong graduate from Indiana University, came to Texas. We'll let him tell his story. But at some period of time after selling real estate, selling business, multifamily business to investors, he transitioned over to owning real estate. And so he tells a great story. And so we're looking forward to have Michael Ochstein with Price Realty on the podcast. So Michael, welcome to the Old Capital Podcast.
Good morning, guys. Hope everyone's doing well and not hanging in the bars these days.
Well, that's where we're making this podcast from, is from the bars.
It's like,
so
here we go.
That's right. Let's kind of talk a little bit about your history. Again, we had you on the podcast about 2-3 years ago, and I think that was a great podcast because I always go with the philosophy is that there are old pilots out there and there are bold pilots out there, but there are no old and bold pilots out there, which means that, if you're going to be around this business for a long period of time, you've got not to take absolute risks and chances. And I think in this cycle, there's been a couple people that have taken absolute chances on some of their transactions that they've gotten into. So I wanted to have kind of Michael kind of talk a little bit about, since he's been in the business for such a long period of time, to give us a little bit of an understanding about how he's been so successful and stayed in this business for a long period of time. So Mike, again, thanks for being on the podcast. Can you give everybody kind of just a background of a little bit of your history?
Yeah, but before I do, remember, I'm learning more from you guys, from an old dog, and being on these podcasts, both what Michael's been able to accomplish and what you're doing and how you're growing your company. And it's, even though I started 83, which seems like yesterday, I love listening to what Michael has to say, what you have to say, and the great thing about multifamily investing, that it never stops. Technology changes, people changes, debt changes, for God's sakes. I mean, like what you were talking about earlier with interest rates. I remember getting it in when interest rates were 21%. Now, I remember my first deal I bought, and I said to the mortgage broker, just get me under 10%. And then a few years ago, I said, if you get me under 4%, I'll buy the closing dinner. And now fast forward, here we are today, and I'm going to be asking to try to get below 3% on 10-year money. It's just, boy, the times, I mean, what we're dealing with today and where interest rates are today, and, it's just incredible.
Walk me back through 1983 and coming to Texas, and what was that like? And with that background, again, we'll talk a little bit about what you've done, but I want to talk a little bit about all the craziness that you actually have seen, because when in 1986, 87, you went through the savings and loan problems. And, 10 years ago, you went through the Great Recession. And now you're going through, like with everybody, going through this pandemic. So you've gone through some of these cycles, which I think are, we could all learn from, of how you come out solid on the other side, that you can play again and keep your balance sheet safe and keep liquidity and do all the stuff. So before we start asking about all these different cycles, let's start at the beginning in coming to Texas.
So I came from the Midwest. You mentioned I graduated from Indiana University, and the Midwest. And the year when I graduated in '82 from IU, I mean, things were just dead in the Midwest. I mean, the manufacturing, the interest rates were high, and the only place that was booming, was Texas. And and then the year before I even came down here, I was doing an internship with a brokerage company in Chicago, and the brokers were just complaining, dying, not doing any deals. And so the best place for me to go was to come to Texas and get involved with Marcus Similichap as an apartment broker, and put me through training school, and started working with a senior associate and learning the business, and basically like everybody else. And what we're doing today is dialing for dollars, trying to find deals, trying to make line up buyers and sellers and make things happen. And it was a great learning experience. And then the first rocket or the market changer was the changing of the tax laws, where I mentioned on other podcasts where everybody was blowing and going, and then lo and behold they changed the tax laws, and a lot of people weren't prepared for it. Overnight they changed everything, so all these deals that were being bought on based on tax shelters didn't make any sense, and debt was coming due, properties weren't worth as much, the NOIs were a lot less, and lo and behold, you had the savings and loan crisis, and a lot of these deals went back to the lenders. And every disruption creates great opportunity, and it was a great opportunity. From my perspective, we were able to represent financial institutions, sell their assets, work with a lot of buyers that were taking gambles to buy here when things were pretty bad. And I was seeing buyers like they're doing today, going firm on deals right away, close in escrow. And so I learned a lot from that. I saw other buyers buy some stuff that I knew that I thought would make sense at low price per unit. And some of those deals today at low price per units don't make a lot of sense because of the economic struggle, the socio-economic struggle, and the management intensity of some of these deals. So the brokerage days, teaches you all that. So the disruption created opportunities, and then eventually, I bought my first duplex, and then, had about 300 units. And I said, I don't want to do this brokerage thing anymore. And bought a deal on the courthouse steps, moved my offices in it. And lo and behold, Price Realty is born. And, we've grown this thing today at over 7,500 units. Right now, we're at a little bit over 5,000 units. And as I was mentioning to Michael Becker and you earlier, fast forward to today, it seemed like this new disruption would create some opportunities, and it probably will. Nobody really knows what third and fourth quarter or even first quarter 21 is going to look like when the stimulus runs out, if people don't get back to work. No one has a crystal ball, but for the first two quarters, I can comfortably say that, and I think Michael attests to this as well, is that we're collecting our rent. We're not getting rental increases. We're not even asking for rental increases unless they're so far below market rents. That's the only thing we're pushing right now, if they're way below. But our NOIs have stayed pretty stable. Our income has stayed stable. And so we're pretty pleased. Now we're kicking the can down the third quarter, and no one knows again. So it's going to be the same questions, going into July. I don't think, or maybe July will be the same, but once the stimulus runs out, or what the Fed does, what happens August, September, and going into the fourth quarter. So there's still a lot of unknowns.
So talk a little bit about, 10 years ago during the Great Recession and kind of leading up to that period of time, because there was another craziness in the market at that period of time. Talk a little bit about some of the things that were going on in multifamily, especially in Texas, because at that period of time, we had a tremendous amount of subprime lending going out there on the single family side. And what type of impact did that have on the multifamily side?
Well, that's the other thing that, a lot of demographics on a lot of these properties during that single family boom, it took a lot of our renters away. And anyone who could breathe could qualify for a loan. And I saw some demographics on some properties that I own that changed overnight. So that had a huge impact. And then obviously when the single family crashed, and then you had the financial crash, and then go up to 2007, 2008, there wasn't any financing to refinance a lot of these deals. I remember I had 3 loans that were coming up in 2008, and there was no debt for them. So the person that held the paper, the BP's bondholder, we had to go back to them and say, look, these properties are well maintained, they're well taken care of. The NOIs have, gone down from when we refinanced them like back in 98, but there's nowhere for me to take this debt and refinance it and pay you off. So come look at the properties, or, if anyone who's listening to this podcast will know that, and I'm sure Michael knows that, you got to always be prepared for that rainy day and make sure that you got reserves, money put away, and you communicate with your lenders and let them know, hey, we're doing everything. Properties are clean. They're well taken care of. There's not a lot of deferred maintenance. That's critical in surviving.
Go back one thing. You were saying the B piece buyer. What is a B piece buyer?
Well, a lot of these mortgages are sold off. You got the A piece, the B piece, and the B piece, I believe, and I'm not an expert on it, Paul. So the B piece has the most amount of risk, and they take a huge portion of the loan. And maybe you can shed some more light on it. And they're the ones that make sure that the bondholders get paid.
That's correct. Yeah, so they're the ones who are actually making the decisions in these deals. And when the B piece buyers, the B piece is kind of a structure of a bond. And if the B piece buyers are not in the marketplace and they're not buying the risk in these deals, then there's no lending. So we saw that probably at the beginning of this last pandemic, that the B piece buyers walked away from the table. They didn't want to take any risk because they didn't know if they could push it out to their investors that were buying the bonds. And so if there's no buyers of these bonds, then there's no really lending, whether it's on the side for the CMBS business or, bank business type of stuff. They're trying to push these loans off. They don't keep them on their balance sheet, and they pass it over to investors. And what's good about Fannie and Freddie is the investor that's really behind the deal is the U.S. government. So they usually don't have a problem because they're always going to show up at the table to buy the risk. And so that's when it's really been a strong market with Fannie and Freddie these days right now, is that the people are actually trading. Fannie and Freddie are probably the best choices because they're still buying, where the CMBS market's not so much on the stuff. Michael Becker, I'm going to kick it over to you.
So what have you seen here now that we're 3 months into it on kind of collections? You own kind of similar stuff to me, kind of a variety of vintage, but you're also down in Houston where we're not. Have you seen any sort of deviation between the property grades from A to C, and then the various Texas markets that you play in? Have you seen any deviation between the different markets on collection rates?
Yeah, so I think Austin and Dallas are staying pretty competitive with each other. Not a big difference between the two. Houston has been, more of a struggle because it's kind of got two things working against it. You have, the oil collapse that's taken place or is now rebounded some, and then you have this COVID. But still in Houston, we're still collecting. Probably at the end of the day, it's a little bit slower than coming in than Dallas and Austin, but we're still collecting over 96%. So even with the issues in Houston, it's still holding up. It's not as robust as Dallas, Austin. And then, to tell you the truth, the last couple of years in Houston, Mike, we haven't had any rent growth whatsoever down in Houston. It's been very.
It's always been a tough market, that coupled with insurance at risk and lenders don't like it as much. It's always been a challenging environment, at least from an outsider's view down in Houston. Have you seen any variance between like your newer Class A stuff versus maybe some of the 80s vintage product that you still own?
Yeah, it's kind of interesting. I mean, I have a deal over at Greenville and LBJ, which is really workforce housing at a kind of on a lower economic. But to tell you that we've collected almost 100% of the rents there. It's called the Park on Greenville, and it's workforce, probably kind of at a lower. And then you compare that to some of the Preston Road, Spring Valley locations, and those deals have been a little bit slower than my Park on Greenville, which is probably one notch lower than the demographics as far as the yearly income, which I was really surprised.
So we were kind of talking like you mentioned before we started recording the podcast. What do you see here? I mean, it seems like the spectrum of outcomes is pretty wide here from, I think anywhere from the future with collections really kind of falling off the cliff in the third, fourth quarter to, them kind of maintaining, pretty well. Like, they certainly have outpaced what I expected them to do. And then as far as kind of how that goes into, asset prices, I mean, I think we all thought we'd see a little bit more dislocation in pricing. And for the most part, it seems like deals that were kind of either were not fully set or trying to be set kind of that March and April timeframe in Dallas, Fort Worth, or Austin, the two markets I focus on, kind of the best or the most you saw was probably a 3 to 5% kind of price adjustment for a period of maybe 6 weeks. And then now it seems like everything's kind of back to where it was in February from a pricing standpoint, if not higher. And I think, as we talked about, 3% interest only certainly helps the economics of the deals. And we're seeing a lot of these deals kind of size, up to 80% leverage, and the escrows kind of got reduced to 9 months of P&I versus 12 months of PITI. So it seems like the lenders really kind of propping up, Freddie and Fannie are really kind of propping up the valuations. Do you think your crystal ball that holds, or do you think we're going to see kind of the next shoe to drop on valuations?
Yeah, I mean, as we talked earlier, is some of the pricing that I've seen on the problem is there's just not a lot of deals out on the market, one. So two, I think once you see a lot more inventory hitting the market, I think that'll change some pricing. But you're right. I mean, this debt market's, it's like it's never been so good. I mean, even with the escrows, I mean, you're still locking in, 10-year money in the low 3% range. That makes a lot of deals work. And then if you add on, if you're getting a lot of interest-only debt and not amortizing the principal, so there's a lot of pent-up capital, and there's a lot of demand to put that capital to work. And, we're underwriting very conservatively, and we're not, showing any type of rent growth for next year, or at least for the first year, and very moderate rent growth going into 22. We're also using a higher economic vacancy factor because there's still a lot of unknowns, what happens in the third and fourth quarter, but speculation is it's a election year, and they're going to keep this economy going because of that. So maybe I should be a little bit more optimistic in the third and fourth quarter, and then once the election's over, then maybe then we see what happens in 21.
Yeah, but you're not putting leverage at 75 or 80%. I mean, what is kind of your average leverage point?
Well, we've been trying to underwrite this stuff to take advantage of getting, interest-only debt. So we've been trying to get debt coverage ratio up to 135, and the debt's been 65%. And even with pricing today at a 125, maybe you get to 70%.
So I think that's an interesting point is, longevity in this business doesn't get you there, as I said, being a bold pilot. It's 75 or 80%. I mean, 60 to 65%. I mean, because you're not going in there and flipping these properties. You are buying these assets, and you're a long-term holder. Is that right?
Yes, we buy these own forever, basically. Like the deal at Preston Spring Valley, that I talked about earlier. We bought that in 2002. The deal at Greenville and LBJ, I bought it in 1995. So we put 10-year debt on all our deals. We fixed rate on all our deals. Some people have done better by doing some LIBOR stuff that gives them more flexibility to sell their assets, because there's two thoughts. If you put some of this fixed rate debt, it lessens your flexibility. If you want to, sell these deals, then you have to have someone come in and assume the debt, and then that takes away somebody's, depends on your plan. Our plan is to maintain these and to buy them and hold on to them forever. This is the way we operate them, and it's the way we put debt on our deals.
The investor that invests with you, is that what they're looking for? Is like cash flow on these properties, over a longer period of time? Kind of give me a background of what the investor looks like.
So our first syndication was in '92, and historically we have produced, and we have sold deals, Paul. But so our average IRR has been north of 15%. Our multiple, I don't have it in front of me, has been close to 3x. People obviously are looking for good cash on cash returns. In the good old days, we're easily able to pay 8, 9, 10% cash on cash. That's getting harder to do because of pricing today. So for our parameters kind of going in, and we want to feel like we can easily pay a 5, 6% today, cash on cash. We always distribute quarterly, 30 days at the end of each quarter. And, our biggest thing since doing this is, there's been some deals and the value add deals has taken a little bit longer to turn, or we've been buying some newer assets, and a lot of times developers just fill these deals up, and once these leases are up, people are jumping boat, so your occupancy falls, and then you got to re-tenant them. So
past performance is no indication of future returns. Let's put that out there. So I mean, you guys have done well. Why would somebody put money into an investment like you guys do versus a real estate investment trust? What's really the difference?
Well, I think, the difference would be that you got, it's a smaller outfit. They got their own skin in the game. The general partner, say being me, you can pick up the phone and call them. You're not picking up and calling some administrator. You're probably closer to the playing field versus going into a REIT. As an LP, maybe you have a little bit more control of your investment. You got some involvement. Now, if you're the type that wants to be really, really, you can be passive on both. But if you want to watch it and you got someone close to the fire every day looking at, deals to buy.
Mike, I'm going to throw it back to you.
You were talking about paying quarterly. Did you guys pay out first quarter, and do you intend on paying out second quarter distributions?
Yeah, we cut our distributions depending on the needs of the asset for that rainy day thing that I talked about. So we did pay out the first quarter, and then we will pay out second quarter, and we'll manage it just looking what we currently have in reserves, what our future needs for that asset, what we're planning in 2021, and does the property need a paint job in 21? Do we have enough money and excess money to still have money in the bank after we paint the property? So there'll be a lot of planning, strategic with my management people, because they know what these assets do need daily, monthly, quarterly. So but we do plan on, to answer your question, we do plan on paying out in the second quarter, and then hopefully we'll just continue. So we're not paying, and that's one thing I wanted to mention, we're not paying out 100%. Freddie Mac, Fannie Mae, that 250, 300, whatever they require in reserves is never enough. So that's why we're always try to put almost $1,000 a door away.
Yeah, I think that's good to kind of show the resilience, at least so far, of multifamily housing, and in particular in Texas market, is that we pay monthly. We suspended 2 months, and then now we turned back on for June, and we plan on playing July. Obviously, keeping a pretty close eye on everything. Mike's been doing this longer than I have, obviously, but I think that's certainly something I've experienced. We've been fortunate to never make any sort of major mistakes, but the minor mistakes we have done have always been coming in maybe just a little light, not taking that extra 100 or 200,000 in on the front end, thinking you can limp in a little short, and it's always better to have a little bit more than a little bit less, because the market's been really resilient, and it's been certainly a secular shift with people renting over the last decade or so, or much more so than kind of 15 years ago, when anyone that could breathe can get a mortgage, and it was a little tougher to operate. So we've had that. Plus, we've seen, kind of a tremendous amount of economic migration from the high price, high regulated markets over the last, say, 15, 20 years to places like Florida, Arizona, and Texas. And my personal crystal ball is I think we're going to see an acceleration of that. I think that if anything, the COVID scare and the crackdown on the local municipalities and regulations and things like that are just going to kind of accelerate what's already been happening. And I think a good example of that is, Tesla's in the process of moving their manufacturing plant from Fremont, California, in the Bay Area to Austin, Texas. So I think that's another feather in the cap of Austin's economic engine. So don't know if you have any sort of kind of forward projections, Mike? I know we kind of talked about the near term, but looking forward 5 or 10 years from now, because you're a long-term owner, what do you expect? I mean, we've obviously seen a pretty large dislocation that I think all think to at least a certain percentage of it's going to be temporary in the employment. We've seen trillions and trillions of dollars printed. We've seen interest rates go to zero, and the pledge of the Federal Reserve to keep them there for the intermediate term, at least 2-3 years. What do you think is going to really happen to Texas multifamily in 5-10 years from now?
I just think, Mike, we're just in such a great place. I think we'll go back to leading the country in job growth, population migration. We got the infrastructure, we have the airports, we have the no income tax. So I think it'll continue to be great for us, especially in Texas. Always my concern, and I've seen it through all these cycles, and is overbuilding. But people got to, when they go to build today, and Dallas in the early '80s, there was just, they didn't have 190 and 121, and they had, and those are all that feel like they're infill today. So for builders to build today, they got to go way out north, or they got to go way out east, or way out west. So infill, population growth, companies moving here. I think it just really bodes well. And we're getting built out in DFW. We're getting built out, in Austin. And Houston is a different story, because they can just go out forever for pastures. But we don't know anything in San Antonio, because I can't speak of it. But I just think the longevity in the future looks great, and we just got to come up with a vaccine and put this COVID thing behind us.
Yeah, my kind of crystal ball is telling me I think we're going to see in 10 years from now, somewhere between a double and a triple of current valuation, just due to all the money they're printing and all the other economic drivers. Is that kind of, it seems like the last cycle from the bottom to the top, we probably about tripled. Seems like rents doubled and prices tripled this last cycle in Dallas-Fort Worth. I think we're going to probably see, another double or triple from current valuations and the next decade by 2030. Do you think I'm wildly off, or is that somewhere in the ballpark where you think we're going to land?
I hope you're right, Mike, because of the price that we're paying for some of these deals. We need all the growth and people moving in here. But look, I've seen deals that I was paying $20,000 a door for, back in the early '90s that are, 5x that amount today. So will it be 5x? Who knows? But does it need to be 5x? Not really. It could be maybe 2x or 1.5 times, as long as that, we continue to present, get good cash flow to these investors, and the assets, maintain the assets, and the future will take care of itself.
Yeah, it's good. Kind of wrapping up, are there any particular submarkets, either in the markets you participate in, that you're a little more bullish on than others?
No, I think, it just got to take each submarket by itself. We're in Richardson, we're in Plano, we're in Arlington. Those are some, we're right in the heart of DFW. So, those are all 4 great areas in Dallas-Fort Worth. Austin, we're pretty well spread out. Houston, we're kind of spread out as well in different submarkets.
So talk to me in the eyes of some of these new folks that have been getting into multifamily. I got folks that say live up in Seattle and they're buying stuff in Georgia, or guys that live in New York and they own a deal in Phoenix and a deal down in Florida. Mike and Mike, you guys have concentrated your efforts to finding one submarket or even one state to stay in. Talk to me about the benefits of just getting into one area and just building those relationships deeper and deeper, instead of hopscotch around the country in different areas to buy, one asset here, one asset there, one asset over there. I find people that do that are almost destitute for failure, or coming into failure. Michael Becker, Michael Ochstein, what's your 2 cents on that?
For me, it's hard enough to walk and chew gum at the same time. So if you're trying to do too many deals in too many markets, and you got yourself spread thin, I think it makes sense to kind of get in a market, buy enough product, establish a base, and then once you kind of get a good fundamental base, I think if you want to then add a second market, that is complementary, I think that makes sense. And then, kind of what we've done, we established a base in Dallas-Fort Worth, and then, 2-3 years ago went to Austin, and now we're 1,300 plus units in Austin. And, I really want to make sure we're at least 2,000 before I can contemplate going to the next market. And, for us, kind of buying, in one state makes it a little bit easier because it's the same state law, you use the same lawyer, you kind of understand a lot of the vendors are the same between the markets. I think going from, I see a lot of guys that buy a small deal in the middle of nowhere, Texas, and middle of nowhere, Oklahoma, and then, maybe one in Memphis, Tennessee, and trying to kind of stay on top of that is challenging because each market certainly functions a little bit differently. And if you have different management and different vendors and different state law, it's just a lot to kind of keep up with. So I think having, a handful of markets and concentrating and maybe diversifying from the types of the assets within the market, or maybe the sub-markets within that greater market might make more sense than trying to bounce around 5-10 different markets, especially when you're relatively small. That'd be my 2 cents.
Mike Ochstein?
Yeah, I agree with Michael. I mean, we made a decision when we first started that we just wanted that hour Southwest flight or drivable or by car 3 hours, and everything is your management team. So in building that base. So I would echo what Michael said. We got regional supervisor in Houston, a regional supervisor in Austin, monitoring the day-to-day. And obviously we split up Dallas between 2 regional managers. So you got to build a base, and you got to build a great management team, or if you hire a management company, at least have an asset manager that's watching the management company, because things can go south very quickly. And if you keep your eye off the ball, that's why we, originally we just, said, let's just stay in Texas, and you can get anywhere in an hour on Southwest, or you can drive 3 hours by car or 4 hours to Houston.
In wrapping this thing up, we were talking about all these old and bold pilots out there. There's been a lot of young, bold pilots out there that have really never gone through numerous cycles like you have. And maybe they're not going to be able to make it out on the other side of this cycle for any problems that may arise. You guys are thinking about putting together an opportunity fund. What is that all about?
So we are putting together a $100 million real estate fund. It's going to be called the Texas Cash Flow Fund. Long-term ownership, quarterly distributions. It'll go into 3 buckets, to buy existing, value add. We're going to look at all facets of what we do. We buy workforce. We buy workforce that has been value add, and we're going to be looking to buy newer stuff. We could also look at possibly do ground up when that comes back. But our primary focus will be to generate current cash with the long-term horizon hold.
Sounds great. So, being an old, bold pilot, that's one of those things out there that you're a little bit more on the conservative side. So we appreciate that. Some great information that's coming out of Michael Ochstein. If people want to get more information about Price Realty and what you do, what's the best way for them to get a hold of you?
So I think go right to our web at pricerealtycorp.com, or feel free to call at 972-788-1925.
That sounds good. Michael Becker, any other words of wisdom in this conversation?
No, Mike Ochstein seems like a smart guy. He agrees with everything I say, so that must make him smart. So
good, you are.
We're both right.
Well, I think you guys are very similar. So I think you both have a similar philosophy. So I definitely appreciate both you guys being on the podcast today. So we appreciate that. Again, Michael Becker, thank you. Mike Ochstein, always a pleasure. We look forward to talking with you again sometime soon. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.